trusts after the Secure Act. Seemed like with COVID and the CARES Act and PPP loans and so much other legislations kind of happened in 2020, we've forgotten about Secure Act, which it's hard to forget that. There's lots of provisions there that are going to affect taxpayers, not just in 2020, but going forward. So we thought this might be a timely topic for you guys, and I hope you find it useful. So we're going to go through this presentation today. There'll be a question and answer period at the end, so you're welcome to go ahead and hit the tag and put your questions out to us, but we'll address those at the end of the presentation. We expect that to last about 50 minutes or so, and then we'll have a period for Q&A.
And we'll also have a contest. You've got to spell our last names correctly without looking back to this first page.
There you go. Okay. All right. Well, on behalf of Silvio Reggiardo and myself, well, again, welcome. And we'll get started now.
Yeah, I guess the one thing I would add on this is that we're going to start off very general and work to some specifics and some fair level of technical detail. And because this is a presentation to professionals from different areas, you might find, for example, that if you're a lawyer and we're talking about income and principal, that you deal with that all the time. It may be something that you find mundane, but others who don't deal with it all the time won't. So we're trying to cover a broad group of people and experiences and information here, but we hope it'll work out for everybody.
Absolutely. All right. Well, so again, the focus of this presentation is on a portion of the Secure Act that deals with trusts and retirement planning with using conduit and accumulation trusts. We're geared towards that part of it. Now, the Secure Act did a number of things, and you've probably noticed there was an increase in the age for the required minimum distributions. There were some changes for part-time workers and how they qualify for 401ks. Now, if you're over 70 and a half, if you want to contribute to an IRA, you can do that. Although I will say that if you're depending on your IRA contributions post 70 and a half to pull you out of lack of planning for your retirement, then you might have made a wrong turn somewhere. But if you want to contribute to an IRA and you're still working after 70 and a half and under the Secure Act, you can certainly do it. But probably the biggest provision that affects our clients and the folks we're working with is this new 10-year distribution rule that replaces the life expectancy rule for inherited IRAs. That's probably the main one. That's the provision that certainly creates the most revenue for the government and has created the most upheaval in terms of our planning. So we'll talk about retirement plan distribution rules. We'll talk about the general trust tax laws in general, and then how it relates to trustees that are in charge of making distributions, providing for income beneficiaries, what decisions you need to make under the Secure Act, and we have a new set of rules governing how we make distributions from retirement and IRA accounts. So for qualified plans and IRAs, this slide here gives us some, I think, some maybe obvious information why we contribute to IRAs and retirements. Well, or retirement accounts, we're providing for our future, right? I've never had a client who's complained about being too wealthy in retirement. I've had plenty complain about having to pay too much tax in retirement, but certainly no one's ever complained about being too wealthy. So contributing to retirement accounts, you don't need an accountant to tell you that it's a good idea if you're in a high tax rate. It makes sense. Now, you may have decisions between Roth IRAs and Roth 401ks. You've got decisions to make about, or I should say you have conversations to make about Roth conversions. But primarily, we're contributing to retirement because it makes sense. We're paying ourselves to save tax. To me, that seems like the best of all worlds. So I love this slide. Too much, too soon, too late, too little. If you added too slow and too loud, it would describe what I heard a lot when I was growing up. But all these seem to apply to retirement accounts and have, I guess, important lessons for each of these bullet points. So for contributions, we know there's contribution limits to IRAs and retirements. That falls in the category of too much. Too soon, if you're pulling money out of retirement, you have potential early withdrawal penalties. It becomes a timing issue. Too late, we have required beginning distributions. You're under the Secure Act, we now have until we're age 72 to make distributions from your retirement. And then you've got too little. If you don't take enough out, you've got requirement of distribution penalties that fall at 50% of the shortfall. It's amazing within the retirement plan framework what the penalties can be for making mistakes, whether it's failing to file, failing to pull out money, being too late or too soon, or too little in terms of how you're managing your distributions. So all these are really important for us to consider as advisors in how we're handling our retirement distributions, retirement contributions, and the timing of those for our clients. So the CARES Act gave us some relief over making a required distribution in 2020. We're now in the almost end of the year. We're now in December. If you haven't taken your IRA distribution at this point, you're not required to do so. I'm sure many of you are already aware of this. It also applies to inherited accounts as well. There was no requirement for 2020 to make a distribution. And with the CARES Act, there was a whole litany of rules around taking distributions out where you can make you can report as income over a period of time. You've got 3 years to do so. We had a presentation back in June on a specific issue. But suffice to say, for at least 2020, if you haven't made your RMD, or if you haven't advised a client to do so, then you can certainly waive that for this year for both RMDs for yourself or for inherited accounts. So the stretch IRA, I'm sure you guys are all aware of this. Under prior law, we had the opportunity for non-spousal beneficiaries to defer IRA payments over the life expectancy of the beneficiary. And it seemed like for years they had talked about changing this, but they talked about it but never did anything about it. And now with the Secure Act, we now have a 10-year rule, as you guys know or should know, for making distributions to beneficiaries from inherited IRAs. And I'm sure I'm not speaking for just myself here, but I did a lot of planning over the years with the expectation to have that stretch IRA law available. And when I thought about my own daughter, who's 17, she's born in 2003, I'm thinking that for retirement contributions I made in the late 80s, that someday go into my rollover IRA, that she might inherit and take over her life expectancy. It could be, and if she lives to be 97, it could be the year 2100, when that last dollar of deferred tax was finally paid. I mean, I'm doing this for dramatic effect. It's 3 centuries, right? Well, now we've got a 10-year window. Now we don't have to take it out in any given year. It's only 10 years. So it's it has created a lot of upheaval in terms of our planning and so the advice that we've given to clients over the years and how to handle stretch IRAs, how to defer that tax for as long as possible.
So it's important to remember that we're talking primarily about stretch IRAs. That's our focus, but in many cases, these IRAs resulted from things like 401k plans that were converted. And those are qualified plans, 401k plans, 403b plans. They involve federal preemption. You don't, in many cases, have flexibility regarding beneficiaries. You may have to designate a spouse. We have legal constraints that apply differently to these different kinds of plans. We're really going to focus on IRAs, but the rules are the same for these qualified plans as well. The trust plan documents apply, but I've never seen a plan document that didn't track the federal distribution laws and weren't as liberal or as restrictive as those laws, which change, of course, as we've just seen. And when we talk about trustee concerns, we're talking about plan assets that are held, I put in trust in quotes, because really a trust is not an entity, it's a fiduciary relationship, and the trustee is holding the assets for the benefit of a beneficiary or beneficiaries. And as we'll see in connection with the see-through trust rules, that's why we get to look through the trust and focus on the individuals in terms of whether they are designated beneficiaries. So this may seem obvious, but a lot of times people focus on what does their will say or what does their trust say. Here we're talking about beneficiary designations. It's a contract and it controls, and it is the critical document in terms of where the plan assets pass. So we've got a delay, by the way, and so Dan has the screen up, and then I'm able to control a screen, and sometimes it's not cooperating. So I'm trying to, there we go. Well, now it seems to have cooperated too much. Let's go back a slide and see if we can, there we go. Okay, so you have to keep in mind the two possible situations that happens when our participant, our owner of the IRA dies. One, the participant has designated a quote designated beneficiary, and that is defined. And by the way, when we talk about these laws, where you'll find the authorities here will be in Internal Revenue Code section 401A9. You'll find the regs, they're easily identified because it's 1.401A9, and then there will be a dash. Typically dash 4 and 5 would be the critical provisions. And then of course we've got private letter rulings, and then we've got Natalie Choate. And I think that would be the sort of the tier of authorities. And there are other people who are really the gurus in this area and spend so much of their time focusing on it. But we have designated beneficiaries. It's right in the code. And the 401A9 says a designated beneficiary is an individual. So you're talking about an individual designated in the beneficiary designation. And that could be a spouse or it could be others. If you look at the statute, it does not mention trusts. You have to go to the regulations for trusts, and we'll talk about the two different kinds of trusts that will allow you to see through. It's called a see-through trust. You can see through or look through the trust to the individual beneficiaries and use their life expectancies in some cases. So the first situation we have is the designated beneficiary. The other one is the participant either failed to designate a beneficiary, didn't make a designation, or designated an entity such as an estate or a charity, and that doesn't qualify. So in either case, a bad designation is the same as no designation. You have no designated beneficiary. So the withdrawal rules that we're going to focus on would be depending upon whether let's say that you have a no designated beneficiary situation, and then Dan will focus on the designated beneficiary situation. He'll talk about when the designated beneficiary is a spouse and when the designated beneficiary is not. But we do not in this screen have a designated beneficiary. So the withdrawal rule that applies when the participant dies and has no designated beneficiary depends upon whether the participant has reached the required beginning date, which, as Dan mentioned, has been stretched out a couple of years now. And so if the participant has not reached that date, then there's a 5-year rule. And all distributions have to be by the end of the 5th year following the participant's death. And actually, if you look at the statute, it just says within 5 years of the participant's death. You go to the regulations that I mentioned, 1.409A-3, I believe it is, gives us a rule that says, no, you get to wait until the end of the 5th year following the participant's death, because otherwise you don't have as much planning opportunities. So that's one rule. And if the decedent or participant has reached the required beginning date, we have what's commonly called the ghost rule, where you pretend that the participant was alive and you use the withdrawal table that the participant was using. So that's the ghost rule. And I think, Dan, you're on the next screen, I believe.
Yeah, and it's it seems like it's more rare that I see no designated beneficiary anymore than 20 years ago or more. I'd see it unfortunately more often than not. Maybe not that much. I saw it often enough where this unfortunately became an issue. But we all seem to be on this to get our clients to make beneficiary designations and then update them as life changes. So.
And by the way, there's a question under the new law as to whether the ghost rule would apply if somebody died and their remaining life expectancy was longer than 10 years. That's an issue that has to be resolved. So we're talking about the 10-year rule, but this is where there's no designated beneficiary. And now Dan's focusing on where there is one, and it's the spouse.
Right. So now, by and large, for spousal IRAs, the rules that were in place before the Secure Act pretty much are in place now. So a spouse can still roll over the plan into their own IRA, can make it their own, right? So then once they do that, at their required beginning date, and required minimum distributions are based on their lives, right? It's as if they own the plan themselves, or they can continue on a participant's plan. They can use a decedent's beginning date. Maybe you have a decedent spouse who is younger than the surviving spouse, and the decedent spouse had already started taking their distributions. And they can also use the decedent spouse RMD. So it's rare that not rolling into the surviving spouse's plan makes sense, but by and large, the Secure Act didn't change much of that. It just changed what happens once the surviving spouse passes and the account goes to somebody else. So then when it's not a surviving spouse, again, this is a 10-year rule. It replaces the life expectancy rule. There are some limited exceptions to it, and we'll talk about that. This is the old rule under the stretch IRA. And again, this applies to accounts prior to 2020, inherited accounts. So if you are using the old stretch rule, it stays in place, it's grandfathered in, so to speak, but the Secure Act applies to accounts inherited in 2020. So in the old rules, based on the beneficiary's life expectancy, you went to the distribution table, figured out how many years you had left. This example kind of walked you through it. It's a divisor, if you will. You take the value of the account at the end of the prior year, divide it by that number, and that was your distribution for that year. Then you reduce that divisor by 1 each year as you march forward. And the younger the survivor, or the younger the beneficiary, then the longer the stretch, if you will. So now we have a new 10-year rule. So participants passing after 1/1/20, non-spouse beneficiaries have 10 years after the year of death to make withdrawals from that plan. Now, there's no required amount in any given year, and you can push it off until the last year if that made the most sense. And this applies to IRAs and Roth IRAs as well. So you can't just have a Roth IRA continue on forever. Now, then, for those who are involved in tax planning, it goes to what can you do in that maybe 10.5 years to minimize the tax or minimize the tax impact of those distributions from the IRA if you have the flexibility. And if for our clients that have fluctuations in income through business planning, tax planning, they got lots of ways we get income down for our clients in a particular year to make it appropriate to take distributions from an IRA. It's the same planning you would do in Roth conversions. But what year does it make sense to take those out? So you've got roughly 10.5 years, we'll call it, over 10 years to make those distributions. And the timing of that is what's going to be critical. So here are the exceptions to it. Spousal beneficiary, again, this is important, that there is no 10-year rule associated with that. For disabled beneficiaries, those are ones who have, get the right language here, long continued and indefinite disabilities. Chronically ill beneficiaries are those who can't, I guess, meet the standard for 2 of the 6 attributes of daily living. All right, the chronically ill designation. For minor beneficiaries, it's still based on the minor's life expectancy. So it's a substantial stretch for at least until they turn the age of majority. That's, I guess, set by state. And then once they hit the age of majority, it's a 10-year distribution rule. And then for surviving spouse, or I'm sorry, for beneficiaries who are less than 10 years younger, the idea here, there's no sort of generational transfer, then the 10-year rule does not apply to someone who is within 10 years of the decedent or as a beneficiary. So those are all the exceptions to it. So then, for the 10-year rule for outright owners, again, we've got to adjust our planning for how we're dealing with our clients. We've got to consider our timing to fit our tax planning needs. When does it make sense to pull the IRA money out? That's the kind of planning we'll be working with our clients. What year and what increments does it make sense? How can we minimize those tax rates? Hopefully, we'll find out at some point when we find out we truly have a president. But at some point, we'll have new tax rates. We know that's all coming. And so, what years does it make sense to do our planning?
So now we're starting to get into, with this slide, some of the complexities with trusts, and we can't confuse the plan withdrawals with the trust distributions. So we now know we're going to have certain different required minimum distribution rules, generally the 10-year rule. But then the trustee has to decide or has to follow the trust document regarding distributions to the beneficiaries. So you really have these two questions. When does the trustee take distributions, and when does the trustee make distributions to the beneficiaries? And so Dan mentioned a minute ago, with the 10-year rule, you can wait basically on average about 10 and a half years. So, what if you draft a document that says, well, don't take any distributions, trustee, until that exceed the required minimum distribution? Well, then in that case, you've tied the trustee's hands because the trustee has to wait until the end of that period. What you might do if you've got potentially minor beneficiaries is say that as long as the beneficiary is an eligible designated beneficiary and can have distributions over a life expectancy, because we're under the life expectancy rule for those folks, take the required minimum distribution only. And then when you're in the 10-year rule, don't mandate anything. Allow the trustee to make those decisions. And as we'll talk about later in the presentation, this gets a little bit tricky because trustees have to look out after all the beneficiaries as they are broadly defined. So when you look at the statute, as I mentioned, it just basically says a designated beneficiary is an individual. You will not see anything about trust. You go to the regulations, and the regulations essentially say, okay, you can look through the trust and treat the individuals who are the beneficiaries, only the individuals, as the designated beneficiaries. So we're effectively ignoring the fact that a trust exists for this purpose. And we have to have meet four requirements. They're fairly easy, valid under state law. I've never seen that fail. Irrevocable by the participant's death. So that's your typical irrevocable trust that's created under somebody's beneficiary designation to a trust that cannot be amended. Then you have one of two different kinds of trusts, and only these kinds. A conduit trust that we'll talk about, and there's nothing in the regs that talks about a conduit trust, but it's a term of art. And then accumulation trusts, those two, that's it. And then certain plan documentation has to be given to the plan administrator by October 31st of the year following the year of death. And there's really no safe harbor for that. You really need to make those deliveries on time. So our old focus was on isolating life expectancies when we had multiple beneficiaries. When we were using trusts and we had beneficiaries who had different ages, a lot of times what we would do is try to focus on the separate share rule, and that's in the regulations. So for example, we would have a long form beneficiary designation. We would actually have the beneficiary designation quote language right out of the trust document regarding the separate shares under the trust document. We wouldn't just simply say that we're designating the XYZ trust. And we don't typically need to focus so much on that anymore, but there may be times when you still want to, and it may be good planning because you could have a situation where you do have minor beneficiaries, for example, and you're still using their life expectancies. So I wouldn't say that you would jettison that planning. You have to think about whether it might make sense to actually continue on trying to focus on the individual life expectancies as opposed to the aggregation rule, which looks at the oldest person's life expectancy. So the old approach was that the trustees would simply take minimum distributions over time, and it would be the required minimum distribution. And who could fault them? If a beneficiary needed more, then the trustee was free to do that if it was in compliance with the trust standards in the trust document. Now we have a much more difficult job for the trustee. It's less predictable because, as Dan mentioned, you have the full 10 years, in most cases a little bit more, to make the distribution. You don't have any required minimum distributions during that 10-year period. Unless you've got an exception where you're looking at a life expectancy, the 10-year rule gives you a lot of latitude that way. And so now we're talking about focusing on both the non-tax law and the tax planning for trust beneficiaries. So the two basic kinds of trusts. A conduit trust is effectively a trust that says whenever distributions are made from the plan, they have to immediately be distributed in full to the beneficiary. And there's no flexibility there. One of the nice things about conduit trusts is that you don't have to focus on contingent beneficiaries. In the world of IRA designations and trust beneficiaries, you have countable beneficiaries and you have potential beneficiaries. And it's kind of like you're a social outcast if you're not countable and you're simply potential, but it's actually a good thing in most cases to just be a potential beneficiary. Well, with respect to conduit trusts, you don't need to focus on any of that. You could have a backup or a contingent charity beneficiary, a charity, or you could have a power of appointment. You can give the beneficiary a general power of appointment, which may be useful for GST purposes, and that's okay. We don't focus on any contingent beneficiaries. We look solely at the primary beneficiary. With an accumulation trust, it's a different situation. You could have multiple primary beneficiaries, but you can't have countable beneficiaries who are not individuals. So if you've got a charity or if you've got a general power of appointment or a limited power of appointment that could be in favor of a non-individual, that's a problem. So you have to really clean those up. An accumulation trust has its trap. And so what happens if you fail? What if you try to draft one of these and you fail? Well, you're really back under the 5-year rule. That's the trade-off. And some people for planning will say, I'm not going to worry about trying to qualify under one of these trusts. I'm going to just simply plan on having a 5-year distribution because now there's less at stake. We're not focusing on distributions over a lifetime. Our trade-off is 5 years versus 10. But the focus to a large degree is on non-tax asset control. So with a conduit trust, one of the big risks is that you're forcing assets out no later than roughly 10 years. And if you're talking about significant amounts of money, it may be inappropriate to be forcing those assets out to a beneficiary who can't handle the assets, who has disabilities and might be a beneficiary of a special needs trust, who has creditor problems. Those are reasons why a conduit trust, though simple, could be a disaster. An accumulation trust allows you a lot more flexibility. You just have to be very careful about the drafting, and there's some uncertainty regarding accumulation trusts under the new laws. ACTEC, the American College of Trust and Estate Council, has some comments in. They have a public page and you can read those. Some of these things will be resolved over time, but in your drafting, you really have to focus on these two different kinds of trusts. And I think under the old approach was, the conduit trust tended to be simpler. We didn't have to worry about these countable versus potential beneficiaries. And we had a long time to stretch the distributions out. So you weren't going to have a real disaster on a distribution. Not so anymore. So that's really the distinction. And again, you're not using a see-through trust unless you're using one of these two particular kinds of trusts. So again, the framework is you have no designated beneficiary, you have a designated beneficiary. If you have a designated beneficiary, it's an individual. And for this purpose, the regulations say that the individual will be the trust beneficiary if the beneficiary is an individual in these two circumstances. So the Secure Act didn't change these laws. It really changed the focus on how we're going to use them. And as I mentioned, you may find that a conduit trust is just too much too soon for the beneficiary. And non-spousal accumulation trusts might make a lot more sense, but they are more complicated. Let's just consider spousal transfers. As Dan said, nothing changed here. And when we do our drafting for spouses, we're typically using either the sweetheart approach, I love you approach, everything outright to the survivor, or an AB approach where the deceased spouse's share is going in trust for the surviving spouse for life, or sometimes a combination based on tax clauses. But the sweetheart approach is almost always used with respect to these IRA distributions, and it has to be used typically for 401k plans. So it's simple, but you have the risk that the surviving spouse might do something different with the assets, something unpredictable. The AB approach is more controlled, but it involves all sorts of trustee duties. And so, IRAs can involve either approach. I think what you're going to find is that in many cases, people are focusing on their trust document, what it says, and they would think, oh, I have a spousal trust, but they're not focusing on what their beneficiary designation says. And in many cases, what you'd find is the right planning would be to have outright transfers to of non-IRA assets to certain beneficiaries, and maybe just go ahead and transfer the IRA to a spouse who has all this flexibility that Dan mentioned. So at this point, Dan and I are both going to have some comments, and basically, briefly, we're talking about tax planning here to a large degree, but we're also focusing on non-tax planning and whether you're throwing too much money in somebody's hands too quickly. And so always think about the non-tax, in my opinion, the non-tax things first. Dan, you may have some thoughts on that. Dan, I don't know if Dan's, it looks like Dan may be frozen on the screen, so I can't tell whether he's still in or not, because normally he's got something to say, and I see him on my screen. It looks like he's frozen. So I'm going to move on to the next slides, and I suspect that if for some reason Dan got disconnected, or maybe I did, that we will.
So I'm having
I heard you, Dan. You
a
there?
little problem with my internet. I hope you guys can hear me.
I don't know if people can hear us or not. Yeah, okay. I see a note saying Dan dropped off. What I don't know, can somebody send me an email indicating whether the participants can hear? Yes, we can. Okay, good. All right. I don't have the screens. I don't have the PowerPoint up, but I'm going to nevertheless continue on for a few minutes, and then we can go through the slides briefly to catch up. So the nature of trusts, I mean, those who are attorneys deal with this all the time, but those who are not don't focus on trusts as much. It's, as I mentioned, it's not an entity. It's a fiduciary relationship. The trustee holds property for another, and the trustee has powers. You'll see a trust document. We'll talk about powers. Trustee has duties and protections. And I remember watching a presentation by Jeff Pennell. He's a professor at Emory Law School, maybe 10 years ago. And he said, nothing says I hate you more than naming you as trustee. And that's true. In my experience, it's a minefield. And I tell clients it's very much like running a hurdle race. You better clear every hurdle on all the many different duties that a trustee has. And because if you fall flat on any of them, you can have a breach of trust. So the participants with a trust would be the trustee, the beneficiaries, and the settlor. And beneficiaries under California law are very, very broad. It looks like maybe we're on to that slide. And looks like Dan is back. Dan, I leapt ahead a little bit, but this is the slide I was working on. So these are the participants in the trust relationship, the trustee and the settlor and the beneficiaries. And in the world of beneficiaries, we have the current or income beneficiaries, and then we've got remainder beneficiaries. And I just hit the next slide, and we'll see whether the internet cooperates and gets me to the next slide. Okay, there we go. Okay, so the trust document generally governs this relationship. It tells the trustee what to do. Probate Code section 16,000 basically says the trustee's job is to follow the trust document. And so when we're drafting, we can actually override many of the trust laws, including income and principal. So that the trust document is going to describe the powers and the duties. We can modify those, and we can also provide protections for trustees, and we often do that. And that will be relevant for some of this drafting that we're talking about, because I've started to do that. I can explain my thoughts on that. So let's see, I just hit the next advanced slide and let's see what happens. So this is important for trusts. The definition of beneficiary is so much broader than people would typically think about. In the Probate Code section 24 basically says anyone who might receive the benefit of trust assets, even if they're unborn or unascertained, they are a beneficiary. And in many cases with trust proceedings, a guardian ad litem has to be appointed to represent their interests. And so when we talk about beneficiaries, most folks think, well, I can identify exactly who the beneficiary is. It would be mom. She's the one receiving the income, or it might be mom and the kids because they're the remainder beneficiaries and after mom. But beneficiaries would be much broader than that, and that's relevant for things like trust modifications and decanting and things where you're trying to change the plan. Okay, so I've just hit the next slide forward, and it's not cooperating. Let's see if it does it. Dan, are you with us still? Dan might have dropped off.
No, I'm back. Can you hear me okay?
I definitely can. What I can't seem to do is get the internet to advance the screen. Okay, so trustee duties, as I mentioned, it can be very risky, but trustees have all of these various duties, and then the probate code has default provisions. So we can override many of these through our drafting. We tend not to do that typically, but it may be useful in connection with drafting for these distributions where the trustee has so much discretion and may feel uncomfortable being provided with that much discretion. So I've got a note saying my internet is unstable, and it looks like Dan's might be as well. So let's see, I'm trying to hit the next page forward. Let's see if that goes. Well, I'm gonna focus on my next slide that's in front of me. So what about protections? So if you're a trustee and you're trying to decide, for example, whether to take a big IRA distribution out of a trust, and you've got 10 years to do that, you might feel nervous because you have these duties to remainder beneficiaries. And the view might be, well, if I take this money and I distribute it to the present beneficiary, the remainder beneficiaries who have rights might be irritated and actually might sue for breach of trust. So that's a concern. In many cases, you can get their consent, or you can do a notice of proposed action, or you can even go to court and ask for permission. Going to court and asking for permission, it's a probate code section 17200 petition. That can be very expensive, but it could be useful if you had a large IRA, for example, and the trustee had a lot of discretion regarding when to make the distribution. A trustee might actually want to ask a court for approval, and then the beneficiaries all get notice of that process. So I've just hit the next slide, and we'll see what happens. Okay, I think we're on to Dan and principal and income.
All right, folks, we'll see if my internet connection stays current here. So we do a number of trust accountings in our firm. We also, I also want to bring up a prior point I think Sil was making. And we also prepare a number of fiduciary income tax returns for estates and trusts. And I will tell you that, I hate to jinx myself, but the audit rate for fiduciary returns is extremely low. I mean, we do 80 or 90 returns a year and have for 25 years. And I can count on one hand, and not using most of my fingers, how many times we've had an audit. And I'm not suggesting you use the audit lottery as a method for tax planning. That's not good. That's not good advice. But suffice to say that from an audit perspective, it's so rare as to be along the lines of a unicorn or close to it. So, we do a number of trust accountings, and the ones that get the most scrutiny are those that have specific income beneficiaries where remainder or other beneficiaries have a vested interest in limiting the income beneficiary to receiving not a penny more than they're supposed to. And the income beneficiary is saying, well, the remainders can get nothing and like it. That's kind of their attitudes about it. So this is a very basic sort of matrix on the idea of receipts being either receipts of principal and receipts of income, and disbursements being associated with income and principal disbursements as well. That's the basis for how we do our accountings. I'm sure maybe you may already know this. Again, this is all based on either the trust document or the principal or the Uniform Principal and Income Act, the probate code, if you will. So, so here's a basic trust example. We've got capital gains that are allocated to principal because that's how they've been. That's the default for how capital gains are treated. Interest and dividends are considered income. And then fees here, and we'll call these fiduciary fees, are split because they apply to both the income and principal component of the trust. And so if you were then in charge of writing a check to the income beneficiary, you'd see that $40,000 would be the check you would need to write to satisfy that income beneficiary. we're going to talk about an example where with the Secure Act and how we're required to treat distributions to a trust, that you could have an issue where you've got what we consider taxable sourced income for income tax purposes, where a distribution of that may not create a deduction, which we'll talk about in a moment. I just want to give you a little framework for what a trust accounting example in its basic form might look like.
So when you look at a document, we draft these to deal with both income and principal. We would typically say, for example, a trustee shall distribute all the income at least annually and as much of the principal for the beneficiary's health, education, maintenance, and support as the trustee deems appropriate. And that's called a HEM standard in the trade. And we can use those for income distributions as well. Sometimes that happens if you've got, for example, young beneficiaries and you're not sure that they should be receiving a lot of income. And with big estates, we do that, or big trusts. A simple trust must distribute all of its income at least annually. When we talk about income for this purpose, it's trust accounting income. And the Internal Revenue Code basically says, focus on trust accounting income. And then then there are fiduciary tax laws that deal with effectively taxable income. So I have just hit the return key, and it's okay. So once again, this is accounting income under the state law. And the document controls. I mean, we can draft it. There's a Uniform Principal and Income Act that has the default provisions. We can actually draft around it. We could say what is normally principal would be considered income. Now, that won't necessarily control for income tax purposes because there could be manipulation. The point being that for the trustee is supposed to follow the trust document. So we pretty much, in many respects, it's the Wild West if you're drafting. You will find, though, that lawyers do not treat it that way. And they will typically, in fact, almost every case, will follow the default provisions of the Uniform Principal and Income Act in defining what is income and what is principal. And so let's talk about the HEM standard. These words will vary. It's a standard that a judge could actually determine would be appropriate. And trustees simply cannot withhold distributions, but must determine a beneficiary's need. So if you have a situation where the trust document says that the beneficiary is to distribute principal for the beneficiary's health, education, maintenance, and support, and you know that the beneficiary does not need the money, then a distribution would be inappropriate. And so trustees don't want to under-distribute or over-distribute, but if they were making a distribution that was out of principle and it was to a beneficiary who did not need the money, and there's a HEM standard applicable, that would be an over-distribution. It would not be a proper distribution. And Dan will have an example where if you make a distribution that is not a proper distribution, you can have a tax surprise.
Right. And I can tell you, in the tax world, we don't like surprises. Now, on this slide, we talk about a few issues related to fiduciary income tax, or at least reporting of returns. Now, trusts pay the same tax rates as individuals. It is the exact same rate schedule in terms of the percentages. What's different is the amount of income to which it applies. So you get to the highest income tax rate on a trust at roughly slightly less than $12,000 of trust income, where it's in the $600,000 range for a married filing joint taxpayer. So you'd be in the same rates, but you're getting there at a much faster interval. And that's why, from a planning standpoint, we avoid, where we can, having trusts pay tax, at least when they're subjected to the highest rates. There's ways we can do that by managing how we manage investments. Of course, that's not my area of expertise, but I can certainly advise on it. We try to avoid the higher rates, not just on the income tax, but the net investment income tax that applies to interest, dividends, and capital gains to the extent they're taxed to the trust. So then, if you make distributions from the trust of income, there's an income distribution deduction. That's how that income flows out through the trust to a beneficiary of that trust, an income beneficiary. And the component calculation of that is called distributable net income, or DNI. So it limits the trust deduction for an income distribution based on DNI. That's sort of the basics of fiduciary income tax. Now, Sil's raising the issue that if you have a trust that is receiving a distribution from an IRA and it's not considered income, then the distribution of that item would not create the income distribution deduction. It may not be considered a proper distribution, right? So you'd be stuck with a situation where you've got a payment to the trust that's not considered accounting income, but it's certainly considered income relative to income tax. And that's our problem. And we'll talk about the concept of trapping of income and having to pay tax at a significant tax rate that you would otherwise be able to avoid if you have a proper distribution that carries out DNI. So, so I'll give you a basic example of DNI and trusts. We've got a Q-tip trust that pays all the income annually to W. She's entitled to distribution to principal under the HEM standard. We assume $100,000 of capital gains, $25,000 of interest and dividends, and no administration costs. But in our normal tax calculations, we look at financial accounting income being $25,000. DNI is $25,000 as well, since we have no other expenses here. The gross income of the trust includes the capital gains, so it shows $125,000. Our income distribution deduction is $25,000, and that's what flows out on a K-1. That's what the income beneficiary would report. And the capital gains to the trust, to the extent that there are tax to the trust, that is the default. The amount of tax paid by that trust for both federal and state, including the Medicare or the net investment income tax, would be just slightly less than $30,000. So again, this is basically paying tax at what is essentially the highest tax rate. This is a basic example of how DNI is calculated and how it affects both the income beneficiary reporting income and how the trust pays tax on capital gains. So again, if you have a hard IRA distribution that is paid to a trust that has a HEMS standard, where the distribution of that IRA is not considered a proper distribution, where we can't take an income distribution deduction for it, we end up paying tax at a fairly high rate. And that's sort of the issue that we're having to address here. And for those who are involved in drafting trust documents, and us as those who are having to prepare tax returns, making sure we're doing, addressing these kind of planning issues is critical. This is now an issue we have with how we have to deal with trust distributions IRA distributions to
Dan, I'm going to go back to the prior slide for just a minute. So let's just do a simple example of two different possible trusts. So let's say that you've come to the end of a 10-year period, and uncle is the current beneficiary, and the remainder of beneficiaries would be nephew and niece. And now you've got like $300,000 to be distributing out of an IRA. And or maybe you're coming to the end and you can maybe take distributions over a couple of years. And nephew and niece say, hey, that's fine, just give it to uncle. He's a great guy and he has a very austere lifestyle. He doesn't need it, but give it to him. He's going to leave it to us anyway. And besides, his tax rate is lower than the trusts and lower than ours. And we think that this is a good thing. So everybody's in agreement. So let's say that you have a conduit trust. So basically the trust document says whenever the trustee receives an IRA distribution, distribute it in full to the beneficiary. Well, it doesn't matter that the IRA distribution would be considered trust principal because the trustee is required to follow the trust document. And the trust document essentially says when you get the IRA, it's a separate paragraph saying when you get the IRA distribution, distribute it immediately to the beneficiary, uncle. And that's a conduit trust. And it was drafted to be that way. Fine. In Dan's example, you've got distributable net income that carries out. It's very similar to the capital gain example, but now it's a proper distribution. And 661 of the code basically says these distributions have to be proper. So now let's do the other example would be an accumulation trust subject to a HEM standard, and uncle doesn't need the money. And nephew and niece say, yeah, give uncle the money. So the trustee does it. And the trustee has actually breached the trust document, not going to get sued because nephew and niece are consenting, but it was not a proper distribution. It violated the HEM standard because uncle didn't need the money. And there's where you're not going to get an income distribution deduction.
Right.
And as a practical matter, it's probably never going to see the light of day, but that's not the question. We really are focusing on what is a proper tax return, and we don't want to walk our clients into a propeller, as one of my professors used to say. So I just hit the page forward, and there we go. So we're actually going to try and wind this up pretty quickly because we plan to talk for no more than an hour, and we'll get there, I think. So drafting and practical problems, the simple trust, the conduit trust could force ill-advised distributions. The HEM standard could be too restrictive. And so you probably, when you're drafting, want to give some discretion. Trustees don't feel good in most cases about having too much discretion. You can draft it to even say as much principle as the trustee sees fit, but trustees typically want more guidance. When I started to draft provisions that give trustees a bit of cover and effectively say, okay, a trustee is not will be exonerated unless the trustee acts in bad faith. So we're not focusing solely on a negligence or breach of trust standard or a lack of prudence. It's bad faith, so that a trustee might feel more comfortable taking on the job of having to do this balancing act and maybe making distributions that would take money out of the hands of remainder beneficiaries and put it in the hands of a current beneficiary. There may be reasons why we want to do that, for tax reasons or other reasons. So that's one of the things to do. Again, in drafting, maybe you want to say that as long as there's a life expectancy calculation, take required minimum distributions under that standard. But when you're under the 10-year rule, don't tie it to the minimum distribution or required minimum distribution, because you don't have to take any during that period. And you want the trustee to have more discretion during that period. So that's some of the drafting. I would put the non-tax considerations first, and just accept the fact that you might have to trap some income in the trust at higher rates, but that's just part of trust administration. Again, it makes it complicated, but we're doing a balancing act. Maybe give trustees more discretion and guidance and more protection, as I mentioned. And let's see. So our responses of the Secure Act really, consider altering plans so that you're maybe dealing with IRAs and other assets differently. So grandmother in this example could leave the large IRA to daughter outright because she can handle it. And we don't want to then have trustee issues and then transfer other assets in trust because you don't have these issues. Maybe the other assets for grandson and granddaughter would be, or grandson in the example, would be more appropriate. You don't have required minimum distributions. Consider Roth conversions. The articles out there are numerous. One of the things that Dan and I feel compelled to mention is the charitable remainder trust, because we are speaking for a charitable foundation. The charitable remainder trust, basically, it can effectively act as a stretch IRA, because if your beneficiary is a CRT, and then distributions are coming out to the remainder, to the lifetime beneficiary in a stretched out way, to some extent, you're circumventing the 10-year rule. You just have to remember that you are leaving assets to a charity. But in many cases, it's kind of a cake and eat it too situation, something to consider. So the takeaway points, Dan and I will wrap it up at this point, but effectively the new 10-year rule is really a major shift. It's an income generator for the federal government and the states as well. It's not going to be difficult to apply outside the context of trust. I think that people are going to focus mostly with their accountants and financial planners on how to deal with these IRAs outside the context of trust. When you're talking about trust, you have all these fiduciary duty issues and discretion. You need to have the protections for the trustee, and consider working around the problem by maybe leaving assets, the IRAs to the spouse, and the other assets, if you've got a mixed marriage, for example, or blended marriage, Leave the IRA assets to the spouse and other assets to the children, that kind of thing. Be creative, because I think it's going to require that we think differently than we did before. A lot of literature out there. The Lineberg group, LISI, has a good presentation. The one thing I would caution about is that they talk about amending trust, and in California that is very hard to do, even with a trust protector. So I won't go into the technical aspects of that, but when you hear some of these things, just remember that it is state by state, and different states have different views about changing trust documents. In California, even with the new decanting law, is very restrictive. So there's a lot of opportunities out there, but really, we just have more complexity. Dan, any concluding remarks?
Yeah, this is sort of, I mentioned it earlier where, they talked about making this change to a 10-year rule or shortening the stretch IRA. Now they've finally done it. And it's really changed our perspective, or it modifies our perspective in terms of how we do tax planning. Now, we've always thought of, as our clients age and they are drawing down in retirement, as they get older, the planning is not just with the retirement account or IRA holder, it's with the family, right? They're considering the tax issues for the beneficiaries. What tax brackets are they in? Frankly, what states do they live in? So and we're focused on the tax side of this, but it's, you do the tax planning as a family, as a group. Who should be paying the taxes on this? Should you be considering late in life Roth conversions, because the rates of tax by the owners are lower than with the potential taxes for the kids? And now we've only got a 10-year rule for Roth IRAs too, and I understand that. But it's still the same perspective. What are the rates relative to the retirement plan holder, and what the beneficiaries could be or would be in the future once we kind of know what rates will be? So to Sil's point, as CPAs, maybe we get a little too myopic on the tax issues, or not, reminded of the fact that estate planning is also about how to control the distribution of assets, and maybe you have to pay a little more tax than you want to, as much as that pains us. That we have to consider the non-tax, the qualitative issues in planning. So.
All right. Well, I think we're probably at the point where we're going to remove the share screen, and I see like 16 chats. I don't know whether those are questions. I suspect it's a mixture of comments and questions. And let's just see what we have here in terms of questions. Okay, none of them are questions. I guess we've answered everybody's questions, and so I think we're concluded. By the way, if anybody has questions afterwards, go ahead and maybe shoot them to, I guess, probably the El Dorado Community Foundation, and then they will get routed to Dan and me, and we will address them. Absolutely.
Yeah, well, again, I appreciate your attendance here. I want to thank you on behalf of the El Dorado Community Foundation, also its Planning Committee. We're putting on a series of these seminars to reach out to advisors to get us all better educated on tax issues as they come up. What are some of the planning issues, and what are some things we should be thinking about as we advise our clients going forward? So again, I don't see any other questions here. So I guess with that, we'll again thank you for attending, and
thanks for attending.
And let us know if there's anything else.